So you're running a small or mid-sized business and you're looking at expanding overseas. Honestly, it's probably one of the most thrilling and, let's be real, absolutely terrifying decisions you'll ever make. Because unlike those massive multinational corporations that are just dropping a tiny drop in the bucket to test a new market, you're likely betting a massive chunk of your own capital. Not to mention, basically all of your waking hours. So consider this explainer your reality check. We're going to take a really hard look at the external constraints that will literally dictate whether your international venture takes off or totally sinks.
Right. Let's kick things off by challenging a super common assumption. Is your company actually ready to go global? You know, a lot of leaders just assume that because their domestic machine is humming, maybe you've got a killer product, a fantastic culture, an airtight management team, that you're practically guaranteed success abroad. But here's the thing. A strong internal readiness score doesn't mean the overseas venture will actually succeed. It really just means your organization is fit enough to make the attempt.
Because the reality, passing that readiness assessment is merely a license to begin the external work. It is absolutely not a substitute for it. The truly catastrophic failures for SMEs expanding overseas, things like launching into a market that, oops, never actually existed, or picking a tax structure that completely traps your cash, or finding out someone else already registered your trademark, those disasters happen entirely outside the boundary of how well your company is run back home.
To help you navigate all that, here's our roadmap for today. We'll start with the Readiness Reality Check, move on to the Entry Mode Ladder, then look at constraints that kill deals, and wrap up with assembling your specialist bench.
All right, part 1, the Readiness Reality Check, separating what's internal from what's external.
Now, think about these external domains. You've got market-facing issues like country screening. You have regulatory hurdles, foreign ownership caps and licensing. Then there's complex tax issues, intellectual property rules, and operational nightmares like tariffs or cross-border systems. Having a fantastic company culture at home does absolutely nothing to protect you from any of this. These external factors dictate your survival. You've just got to master them.
Moving right along to part 2, the Entry Mode Ladder. This is where we get into the actual execution.
So the absolute golden rule for SMEs looking to expand is understanding that entry modes form a ladder. It's a ladder of rising commitment, rising control, and crucially, falling reversibility. The discipline you need here is actually pretty simple to say but hard to do. Start at the lowest possible rung to gather your market data and climb only, and I mean absolutely only, when the market has actually proven itself and essentially paid for that next step. Now in practice, there are basically 10 distinct rungs on this ladder, ranging from a simple online sale all the way up to a total corporate relocation.
Looking at these 5 major milestones, you can clearly see how every step up gives you more control, but drastically reduces your ability to just reverse course if things go south. Down at the bottom, direct export is highly reversible, but you get zero market feedback loop. Then you step up through agents, distributors, joint ventures. And sure, they give you a foothold, but they bring new risks, like getting hit with massive unexpected termination compensation, or just totally losing visibility of who your end customers actually are. And finally, at the very top, you've got the completely irreversible greenfield subsidiary, meaning you own the whole operation.
And look, the instinct of any ambitious SME owner is often to establish a proper presence right out of the gate. You want to rent a slick office, hire a local team. It signals that you're serious, right? But jumping straight from direct export all the way to a greenfield subsidiary is literally the most expensive, least reversible way to test if a market even wants your product. For an SME, taking that leap is a massive and, quite frankly, often fatal mistake.
Which brings us perfectly to part 3, constraints that kill deals. These are the permanent mistakes.
I want to really slow down here for a second, because this is absolutely crucial. If you take literally nothing else away from this whole explainer, memorize this. File before you fly. Failing to register your intellectual property before you make a public launch, or even before you have a quiet partner discussion, is the single mistake most likely to be completely unrecoverable. IP rights are territorial, so never ever let a local distributor register your IP in their name just for convenience. Secure it in your name, lock it down before you even board the plane.
And it's not just IP. Simply changing how you enter a market totally transforms your tax reality too. Doing direct exports? Okay, you're usually taxed at home only. But establish a subsidiary? Boom, you are now a completely separate taxpayer in that foreign jurisdiction. Suddenly, dividends face withholding taxes, and you're navigating complex profit repatriation routes just to get your own money back. This is exactly why your structure has to be chosen deliberately, not accidentally. So, how do you avoid these traps? That brings us to our final section, Part 4, your specialist bench.
Sequencing matters immensely here, but so does matching the right specialist to the exact rung of that entry ladder we talked about. Let's actually break this down across all 10 rungs. It's like a giant puzzle. If you're just on rung 1 doing online sales, you basically need an IP agent, a customs classification expert, and a tax view on indirect tax and marketplace obligations. But let's say you move to rung 2, using a distributor or agent. Now you need a commercial lawyer specifically to warn you about the termination compensation trap, plus your IP agent and a solid credit and collections view. Climbing up to rungs 3 and 4, which is licensing and franchising, you've got to bring in a franchise lawyer who knows registration and disclosure regimes, your IP agent, a tax expert for withholding on royalties, and a certification consultant. Okay, rung 5, establishing a representative office. For this, you need a corporate lawyer to explain exactly what that office may not do, an employment lawyer, and a tax advisor for permanent establishment risks. Hitting rung 6, an alliance or JV, you need that corporate lawyer again, experts on IP and confidentiality, a dispute forum expert, and someone who understands cross-border professional indemnity. Getting serious at rung 7 with a full sales office means you need all of the above, plus experts in payroll, statutory contributions, transfer pricing, and a written intercompany agreement. Rungs 8 and 9, that's partial relocation and assembly, now you're adding customs and origin experts on both sides of the border, specialists in data transfer rules, currency exposure, and a strict hedging policy. And finally, rung 10, total relocation. This requires absolutely everything we just listed, plus a hard, independent second opinion on whether the actual value being moved survives the move itself. Wow. So yeah, get the sequence wrong and the whole strategy collapses.
Now, when you're interviewing these highly paid specialists, I want you to ask them this exact question. What are the 3 things companies like mine most often get wrong here? Their answer is a dead giveaway. It instantly reveals whether they have genuine, practical pattern knowledge of that specific market, or if they're just reading you the statute from a textbook. You need people who've seen SMEs crash and burn and know exactly how to guide you around those real-world landmines.
Your bench has to provide granular, market-facing detail. I mean, don't just ask them about high-level GDP growth. You need to know what comparable products actually transact at, net of channel margin. You need to know the typical payment behaviors and the real days sales outstanding in that specific market. Always demand real-world actionable intelligence, not just some theoretical spreadsheet data.
Well, we've definitely covered a lot of ground today, from that entry mode ladder all the way to the absolute hard constraints of tax and IP. So I want to leave you with a final, somewhat provocative thought. Ask yourself, are you building a proper presence overseas, or are you just buying an incredibly expensive distraction? Remember, as a time-poor executive running an SME, it is not just your cash on the line. Your management focus is your absolute most finite, most valuable capital. Don't waste it on the wrong market or the wrong entry structure. Expand smarter and expand safer.